In this video, we're going to go over the math on 401k accounts. We're going to figure out how much money you'd be able to pull from retirement depending on certain scenarios. And we're going to go over this using both types of 401ks, the traditional and the Roth. And just a quick recap here. Remember, traditional 401k decreases your taxable income. And when you contribute to a traditional 401k, you can deduct the amount you contributed from your taxes. So essentially use it as tax write-offs. And the caveat to this, the negative part is that your withdrawals in retirement are going to be taxed though. Roth 401k is the opposite. Taxes are taken out immediately, so you're taxed just normally as any sort of income. But the good part is that your withdrawals are not taxed in retirement. So when you take something out in retirement, you don't have to pay extra taxes like you do on the traditional. So again, the basic idea for both of these is the traditional, you get taxed when you're old, and the Roth, you're going to be taxed when you're young. So now let's do some math on these, and we're going to do this same scenario for both. And let's say that you work at Nike, and you have worked at Nike for 30 years, and over that period, you received an average salary of $85,000. And then every year you've worked there, you've been good, you've invested 10% of your salary into your 401k, and Nike has matched that. But again, most companies only match to a maximum of 6%. And then in the 30 years, your 401k account, the investment has gained 6% per year in extra interest. And then just assume we're just going to use 25% as an overall deduction for taxes. And now we're going to do this scenario for both the traditional and Roth. And we're going to figure out how much money you'd be able to withdraw in 30 years using the 4% rule. So we're going to start with the traditional 401k. And remember, you are investing 10% of $85,000 each year. So again, to calculate how much you're investing, you're going to go 85,000 times 0.10, which is this multiplier of 10%. So that means you're investing $8,500 each year. Then we're going to do the same with Nike. Nike is investing 6% of $85,000 each year. So we're going to go 85,000 times 0.06. And that means Nike's investing $5,100 each year into your 401k. So that means the total amount being invested in your 401k each year is you plus Nike's contribution. So that means that's going to be a total of $8,500 plus $5,100. So that means $13,600 being contributed each year to that 401k. And remember, this is a traditional 401k, so initial investments are untaxed. So this is just going in each year untaxed. And in this scenario, you're saying your 401k is going to get an average of 6% of yearly gains year over year. And remember, for traditional, at the very end, when we take our withdrawals out, we're going to have to deduct 25%. So we're going to do all this using NerdWallet's compound interest calculator, figure out how much that account's worth and how much we can withdraw using the 4% rule. So we're in NerdWallet. We're going to figure out how much this traditional IRA would gain after 30 years. So our initial deposit, we're going to put 0 because it's like we're starting from year 1 and doing it to year 30. Our contribution amount we found was $13,600 a year. And again, the frequency is annually, not monthly. So again, remember to check annually. Years of growth, remember this was over a 30-year period. Our average rate of return we said was at 6%. And compound frequency always set for annually. So that means after 30 years contributing to this 401k traditional, the account balance is at $1,075,000, $191.33. Now we're going to do the same thing with the Roth IRA. And so again, the amount you and Nike invest each year is going to be the same. So you add again your contributions plus Nike. It's going to be $13,600 each year. But remember, with Roth, you're taxed initially. So 25% is a good rough number to assume how much you'd have to pay in the taxes on those. So tax at 25%. So that means if we're taxed at 25%, we're going to multiply this by what would be 75%, because that means 75% is left over after we take out 25. So we're going to multiply 13,600 by 0.75. And so that's going to give us $10,200 each year after the taxes are taken out. We're investing into this Roth. And remember, 6% average yearly gains. And then the good part about the Roth is once the money's in there, it stays there, no taxes after that, because you don't tax on the withdrawals. We're going to do the same thing. We're going to go to NerdWallet with this one as well. Do the exact same thing. Try to figure out this Roth 401k, how much is in that account. So again, our initial deposit is $0. We found that after the taxes are taken out for the Roth, we're going to contribute $10,200 per year. And again, the contribution frequency, we're doing it annually per year. And years of growth, same as 30. Estimated return, we're going to say 6%. And remember, the frequency set annually. So the account balance of that 401k in the Roth is $806,393. But remember, when you withdraw from this, you don't have to pay taxes on it like you do the traditional. Okay, so we figured out the account values on both, and now it's time for the head-to-head matchup, traditional versus Roth. So remember, the account value that the traditional would be at would be a little over $1 million. And remember, now we're going to use that 4% rule. So let's say we're taking out 4% per year. So we're going to multiply that by 0.04. And that's going to give us $43,007 of spendable income. But remember, this is a traditional. So now that it's withdrawn, now we actually have to take out the taxes. So we're going to multiply that, assuming roughly 25%. We're going to now multiply this by 0.75. So that's going to give us $32,255 of spendable income, because again, you got to account for those taxes. So now that's the number to beat for the Roth. And so let's say our account value is at $806,393 is what we found. And the good thing is we don't have to take out any taxes on this when we do our withdrawal. So let's do our 4% rule. And if you multiply that by 0.04, that's actually going to give you the same number, $32,255. So you see, there really doesn't matter which one you prefer, the traditional or the Roth. It's more a matter of, would you rather be taxed when you're old or taxed when you're young?